If I told you that the number 142,250 could silently trigger a wave of anxiety, influence the price of the bread on your table, and even determine the future of an entire nation's political stability, would you believe me? For the millions of people in Iraq, that isn't a hypothetical question. It's the stark reality they woke up to this past Saturday. This specific number, 142,250 Iraqi dinars for every 100 US dollars, isn't just a digit on a trader's screen in Baghdad's bustling Al-Khifa and Al-Harithia stock exchanges. It is a vital sign, a pulse check on the economic health of a country with one of the world's largest proven oil reserves. This recent climb, from Thursday's rate of 141,900, might seem like a minor fluctuation to an outsider, a mere blip in the global financial radar. But within the local markets of Baghdad and Erbil, this subtle shift is a deafening alarm bell, echoing through the narrow alleys where shopkeepers price their goods and in the homes where families budget for the month. The story behind this number is not just about currency valuations. It is a complex and gripping saga of geopolitics, internal strife, and a nation's fragile journey towards economic sovereignty. This isn't a dry financial report. This is a real-life economic thriller playing out in real time, and its consequences are felt by every single Iraqi citizen from the capital to the Kurdistan region. The immediate cause for this specific weekend surge can often be traced to a cocktail of local and international pressures. Internationally, the U.S. Federal Reserve's monetary policy decisions, which might seem distant and abstract in Washington, have a direct and immediate impact on the availability of physical U.S. dollars in Iraq. Iraq's economy is still heavily dependent on the dollar for oil sales and international trade, creating a vulnerable dependency. Any tightening of dollar liquidity by the Fed, or increased global demand for the U.S. currency, creates a supply squeeze that instantly makes dollars more expensive to acquire in the Iraqi market. This external pressure is then massively amplified by internal dynamics. For years, a significant shadow economy and the power of well-connected currency smuggling networks have drained dollars from the official system, funneling them to sanctioned countries like Iran and Syria, effectively bleeding the central bank of Iraq's reserves. In response, the U.S. and the Central Bank of Iraq have implemented draconian measures to control the flow of dollars, especially through the International Electronic Platform for Financial Transfers. While intended to curb illicit financial flows and money laundering, these measures often have a collateral damage effect. They strangle the legitimate supply of dollars needed for honest importers and businesses. When an Iraqi businessman cannot access enough dollars at the official rate to pay for imported medicines, car parts, or machinery, they are forced to turn to the parallel market, where the price is dictated by scarcity and high demand, inevitably driving the street price higher. This creates a vicious cycle where official measures to stabilize the currency inadvertently fuel the very black market they are trying to eliminate. The psychological impact on the average citizen cannot be overstated. When people see the dollar's value climbing on the news, their first instinct is fear. Fear that their life savings, held in dinars, are evaporating in value. This triggers a rush to convert dinar savings into dollars or tangible assets like gold, an action that further increases the demand for the dollar and pushes its price even higher in a self-fulfilling prophecy. So, when the selling rate in Baghdad's exchange stores hits 143,500 dinars for every $100, and the buying rate sits at 141,500, that spread isn't just a trader's profit margin. It's a direct tax on the purchasing power of every Iraqi. The price of imported goods, from wheat and cooking oil to electronics and pharmaceuticals, is instantly recalculated upwards. Inflation, that silent thief, begins to erode the standard of living, pushing more people into poverty and creating a fertile ground for social unrest and political disillusionment. This single number, 142,250, is therefore a key that unlocks a deep understanding of the immense challenges Iraq faces on its path to recovery. Now, let's zoom in on the other critical number from this weekend's financial data: 141,900. While Baghdad was dealing with its own set of pressures, in the northern city of Erbil, the capital of the Kurdistan region, the selling price of the dollar reached 141,900 dinars for every $100. This figure is not just a statistic. It is a powerful lens through which we can examine the profound and often painful economic divergence between the Kurdistan region and the federal government in Baghdad, a rift that turns the dinar's fluctuation from a national issue into a deeply regional and political one. For years, the Kurdistan Regional Government, or KRG, has prided itself on being a more stable and economically promising enclave within the tumultuous landscape of Iraq, largely built on the backbone of its independent oil exports. However, this very independence has become its Achilles heel in the ongoing currency crisis. The heart of the issue lies in a bitter and protracted dispute over oil revenue sharing and budget allocations from Baghdad. The federal government has consistently used financial pressure as a lever to force the KRG into conceding greater control over its oil resources and to fall in line with federal energy policies. This has resulted in Baghdad frequently withholding or significantly delaying the KRG's share of the federal budget, effectively starving the regional government of the dinars it needs to pay its staggering number of public sector employees, a group that forms the very core of Erbil's consumer economy. Without a steady stream of dinars from Baghdad to pay these salaries, the KRG is forced to find alternative, and often more expensive, ways to generate Iraqi currency. One of their primary methods has been to sell the dollars they earn from their own independent oil sales in the local market to obtain dinars. This creates a paradoxical situation where the region, which is selling a valuable dollar-earning commodity like oil, is simultaneously flooding its own market with dollars supplied to buy dinars, which can sometimes depress the local dollar price. However, when this flow is disrupted by federal policies or by the recent stringent international controls on dollar transfers, the mechanism breaks down catastrophically. The KRG finds itself dollar-rich but dinar-poor, unable to meet its most basic domestic obligations. This forces the regional government and local businesses to turn to the same volatile parallel market that Baghdad is trying to suppress, thereby directly linking Erbil's financial stability to the very black market dynamics the central bank is fighting. The recent rate of 141,900 in Erbil is a stark symptom of this breakdown. It represents a desperate need for dinars, driving up the cost to acquire them with dollars. For the average family in Erbil, this translates into public sector salaries being paid late, in installments, or sometimes not at all, crushing the spending power that drives the local economy. Shopkeepers in the famed Kaysari Bazaar see sales plummet as customers vanish, not out of choice, but out of necessity. The social contract, the promise of stability and prosperity that has long been the KRG's main claim to legitimacy, begins to fray at the edges. This economic pressure from Baghdad is not merely a financial tactic. It is a potent form of political coercion, designed to bring a semi-autonomous region to heel by squeezing its economy until it capitulates on broader political demands. Furthermore, the situation in Erbil is compounded by a profound sense of uncertainty and a lack of foreign investor confidence. International companies that were once eager to invest in what was seen as the other Iraq are now hesitant, scared away by the political instability and the unpredictable fiscal environment. Who would invest in a region where the local currency's value is a political football kick between Erbil and Baghdad, and where the rules of the game can change overnight with a new directive from the federal treasury? This investment drought stifles job creation in the private sector, leaving the already strained public sector as the only viable employer for many, further tightening the federal government's grip. Therefore, The dollar rate in Erbil is more than just an exchange rate. It is a barometer of a high-stakes political struggle, a number that measures the intensity of the tug-of-war between centralization and autonomy. It tells a story of a region caught between its aspirations for self-reliance and the hard reality of its economic dependencies, where the dream of building a prosperous statelet is constantly challenged by the gravitational pull of the federal center. Every tick upwards in that number is a reminder that in Iraq, economics and politics are two sides of the same coin, and right now, that coin is looking increasingly devalued. So where does this leave us? And more importantly, where does it leave the future of Iraq's economy? The recurring nightmare of a fluctuating dinar is not a force of nature. It is a man-made crisis, and therefore, it demands man-made solutions that are as bold and comprehensive as the problems are deep-rooted. The path forward is fraught with challenges, but it is not invisible. The first and most critical step, which is often stated but rarely acted upon with genuine commitment, is the absolute and urgent need for economic diversification. Iraq cannot continue to be a one-trick pony, with over 90% of its government revenue tied to the volatile global oil market. Every time the dollar strengthens or oil prices dip, the entire economic house of cards in Baghdad and Erbil trembles. The government must launch a Marshall Plan-level investment into agriculture, manufacturing, and tourism, sectors that were once the pride of the nation. Imagine reviving the Mesopotamian breadbasket to not only achieve food security, but to become a net exporter of wheat and dates, earning valuable foreign currency from a source other than oil. Imagine leveraging Iraq's profound historical and religious sites, from the ancient ruins of Babylon to the holy cities of Najaf and Karbala, to build a world-class tourism industry that creates millions of jobs and brings in dollars directly from visitors, strengthening the dinar organically. This diversification would fundamentally alter the demand for the dollar, reducing the economy's desperate, structural dependency on it. Secondly, the systemic corruption and the powerful, shadowy networks that facilitate the smuggling of dollars must be dismantled. This is not a task for half measures or political theatrics. It requires a ruthless, technologically driven assault on the very infrastructure of illicit finance. The Central Bank of Iraq must continue to modernize, deploying blockchain-like technology to track every single dollar that enters the country, from the moment it is received for an oil shipment to the moment it is spent by an importer for legitimate goods. Any breach in this chain must be met with immediate and severe consequences. This will require a level of political will that has been conspicuously absent, as it inevitably means confronting powerful militias and political factions that profit handsomely from the current chaotic system. The government must make a clear and brutal choice. It either serves the people or it serves the corrupt elites. It cannot do both. The recent measures to control the dollar supply through the official platform are a step, but they are a defensive one. What is needed is an offensive strategy to make corruption and smuggling and possibly high-risk endeavors. Finally, and perhaps most importantly, is the need for a new social and political contract between Baghdad and Erbil. The current model of using financial starvation as a weapon to settle political scores is a recipe for collective suicide. Both sides are losing. Baghdad's strategy weakens the integrity of the nation and fuels separatism, while Erbil's defiance impoverishes its own people. A grand, transparent, and legally binding agreement on oil and revenue sharing is not just an economic necessity. It is a national security imperative. This would stabilize the flow of dinars to the KRG, allowing it to pay salaries on time and restore confidence in its local market, which would, in turn, stabilize the dinar's value in the north and reduce the pressure on the parallel market. This stability would be the single greatest signal to international investors that Iraq is finally open for serious business. When the world sees that the two most powerful political entities in Iraq can cooperate on the most fundamental aspect of statehood, the economy, a wave of confidence and capital will flow into the country, strengthening the dinar not through artificial measures, but through genuine growth and optimism. The rise of the dollar in Baghdad and Erbil this weekend is a warning, a symptom of a much deeper sickness. But it is also an opportunity, a chance to look in the mirror and decide that the era of oil dependency, corruption, and political infighting must end. The solutions are difficult, they are expensive, and they will face fierce resistance from those who benefit from the status quo. But the alternative, a continued descent into economic instability and social unrest, is simply unthinkable. The power to change the number on the screen from 142,250 to something that signifies strength and stability doesn't lie with the U.S. Federal Reserve or global markets. It lies within the halls of power in Baghdad and Erbil, and with the unwavering demand for change from the Iraqi people themselves.